Welcome back to the Deep Dive, where we extract the most vital insights from the stack of sources you need to master. Today, we are wrestling with a giant, the retirement savings vehicle that really defines modern American finance, the 401k.
It really is. It's absolutely central to the financial lives of millions. And yet, for something holding, what, around $6.4 trillion in
A
assets?
staggering number.
Yeah, the complexity and the jargon are just they're staggering. Our goal today is to take you beyond that acronym. We want to give you not just the rules and the limits, but the strategy and really the philosophy behind them.
Exactly. And we've pulled together everything we could find. We've got the historical records, the detailed IRS rules, and some surprisingly sharp criticism.
Including one from the man who basically created the modern version of the plan.
Right. So our mission for you, the listener, is pretty simple. We want to demystify the structure, help you understand the mechanics, and really evaluate the trade-offs of this powerful, but let's be honest, very complicated savings vehicle.
And the deeper you look, the more striking the history becomes. I mean, this cornerstone of national retirement savings. It was never designed to be a national system.
No, not at all. And this is where it gets really interesting. The 401k was an unexpected legislative accident. It came out of the Revenue Act of 1978, and it started as a loophole.
A niche tax strategy.
Exactly. A niche strategy to help highly compensated executives minimize their tax exposure. And this is the key part. This was during a period when the top marginal income tax rate was a jaw-dropping 70%. We will definitely come back to how that context shaped the system we have today. #I, the unexpected history and core definition. Okay, let's unpack this from the very beginning. We hear the term 401k all the time, but what exactly, what does that specific subsection of the U.S. Internal Revenue Code officially define it as?
Well, at its heart, it's an employer-sponsored defined contribution plan.
Okay, defined contribution. Break that down.
That phrase is absolutely key. It means the benefit you get in retirement is defined only by how much is put in, by you and your employer, and how well those investments do over time.
So it's not a guarantee.
No, not at all. It's a personal retirement savings account that is, tethered to your job.
And the main mechanism is that employees make these periodic contributions, either pre-tax or post-tax, straight from their paychecks, right?
Straight from the paycheck, often supplemented by an employer match. And from the employer side, from a bookkeeping perspective, which, you as the employee never see, those funds are handled in a very specific way.
Oh, so?
The second that money is withheld, the employer's obligation to send it to the plan administrator is immediately classified on their books, on the general ledger, as a payroll liability account.
So it's money they legally owe.
Instantly. And they have to transfer it, usually within a few business days. It's a highly regulated, very current liability.
Now let's get back to that unexpected history. You mentioned this kind of plan was actually banned for a while. What was going on in the 70s?
Yeah, so before 1974, some employers offered this choice, a cash or deferred option. You could take the money as taxable cash now, or you could have the employer put it into a retirement plan for you.
Okay.
But Congress got worried. They saw that these were being used, maybe a little too aggressively, by high-paid people, mostly for tax sheltering. So they just put a stop to it. They put a moratorium on any new plans while they studied how to regulate them.
And that study led to the Revenue Act of 1978.
Exactly. The new legislation got wrapped into that massive act, specifically in Section 401k, which reauthorized these cash or deferred plans, but only if they met these new, much stricter non-discrimination tests.
And companies jumped on it pretty fast.
Incredibly fast. That reauthorization was enacted in November of '78. And the records we have show that a company like Hughes Aircraft was among the very first to implement a plan just weeks later.
Wow.
It shows they were already thinking about how to transition their existing savings plans into this new, tax-advantaged framework.
But the real name to know here is Ted Benna. He's the one who gets credit for creating the first truly functioning 401k plan at his employer, the Johnson Companies. And his goal wasn't to, save America's retirement.
No, his motivation was purely tactical. It was all about cutting the current tax bill for executives.
Right.
Benna was working with these bank executives who were getting deferred compensation bonuses, and they were just desperate for a way to shelter that income.
And you have to put yourself in their shoes. A high earner in the late 70s, early 80s, looking at a marginal tax rate of 70%.
That's a massive financial incentive. You're going to find any legal way you can to push that income into a structure where it's not taxed immediately.
70%. That context just changes everything about why this was created. The whole point of the original 401k was about minimizing a huge current tax bill. It wasn't about, say, long-term compound interest for the middle class.
Precisely. Benna realized the new 401k language let employees defer salary on a pre-tax basis, and that it could apply to current income, not just profit sharing. His first plan let people contribute up to 25% of their salary, capped at $30,000 a year.
Those are huge numbers for back then.
They are. And they clearly show the initial focus was on high earner tax mitigation. That niche idea it exploded, and it morphed into the mass retirement vehicle we have today, almost completely by accident.
So this accidental history brings us right to the most fundamental decision you face when you open a new 401k.
The big one.
Traditional or Roth. This choice is all about when you pay the tax bill. And, tax experts have these models for it, ET&T.
Right. The traditional plan follows the exempt, taxed, or ET model. And the Roth follows the taxed, exempt, or 2 model.
Okay.
And the critical thing to see here is that in both models, that middle E, the middle exempt, refers to the growth. The growth of your investments is permanently tax-free. You never, ever pay tax on the profits your money generates.
Okay, so let's start with the classic, the traditional or pre-tax 401k, the classic deferral.
So when you contribute to a traditional account, that money gets deducted from your taxable income for this year.
So you get an immediate tax break.
An immediate, and if you're in a high tax bracket, a powerful break. It's a very substantial benefit. But, and this is important, the deferral only applies to your income tax.
What about payroll taxes?
You still pay them. Crucially, you still pay the full 7.65% for Social Security and Medicare on that contribution. That tax is not deferred. It doesn't matter if you choose traditional or Roth.
And the income tax bill it comes due later.
It comes due when you take the money out in retirement.
So if you're a listener, you're essentially making a bet.
That's a great way to put it.
You're betting that your personal income tax rate, your marginal rate, is going to be lower when you retire than it is right now in your prime earning years.
That is the core calculation. If you contribute while you're in a 35% bracket and you retire into a 15% bracket, you win that bet. Big time.
But what if you lose?
Well, if future tax policy changes, or maybe your required minimum distributions force you to withdraw a lot of money.
Right.
And that pushes your retirement income into a higher tax bracket than when you contributed, then the deferral actually backfires. It becomes a penalty.
Okay, now let's flip that for the Roth 401k. With the Roth, the pain is all upfront.
Exactly. Roth contributions are made with post-tax money.
Mm-hmm.
You don't get a tax deduction now, so you feel that tax hit immediately. But the monumental benefit is on the back end.
Tax-free.
Qualified distributions in retirement are completely 100% tax-free.
Right.
You will never owe the government another dime on that money. Not the principal, not the growth.
So let's be very clear about the rules for qualified distributions. They're strict.
Very strict. We looked into the code, and 2 things have to be true at the same time. First, the distribution has to happen more than 5 years after your very first Roth contribution to that specific plan.
The 5-year clock.
Right. And second, the withdrawal can't be made before you turn 59 and a half unless a very specific exception applies, which are detailed in IRS Code Section 72T.
And there's a key administrative difference here from an IRA. A Roth 401k contribution, once you make it, it's set in stone.
It's irrevocable. You can't later convert it back to a pre-tax traditional contribution. With a Roth IRA, you can do that. Not so with a 401k.
So this brings us to what you said is the profound insight connecting both accounts.
The permanently tax-free profits on your after-tax savings. This is the real A-plus advantage. It's not the deferral itself.
Okay, this is a nuanced point, and I think we really need to spend a minute on it because it forces you to think about the traditional account in a totally different way.
It really does. So let's use a conceptual model.
Yeah.
Think of it as the government co-owner.
Okay.
When you contribute pre-tax to a traditional account, you get that immediate tax reduction.
Mm-hmm.
Conceptually, that tax reduction is the government investing its share right alongside yours. They are essentially lending you that money to invest tax-free.
So if I contribute $1,000 and my tax rate is, say, 25%, the government basically owns $250 of that amount, but I get to invest and manage the whole $1,000.
Exactly right. And that full $1,000 grows tax-free for decades. When you finally take a distribution in retirement, the tax you pay on that withdrawal is just the government reclaiming its $250 share of the principal.
Okay.
Plus the profits that its $250 share generated, all calculated at whatever your tax rate is in retirement.
So the withdrawal tax isn't a tax on my growth. It's just the government taking back its loan plus plus its share of the profits. The money I actually saved, my original $750, that part grew tax-free forever.
That is the crucial synthesis. The only real difference between traditional and Roth is who gets to benefit from the leverage on the government's portion.
Right.
If you bet correctly on a lower tax rate in retirement, you win because the government takes less back. But the tax-free growth is the core feature of the whole vehicle, no matter when you pay the tax.
So, to boil that all down, the only true benefit in both systems is tax-free growth, and the timing of the tax is just a bet on future tax rates. Is that the simplest way to say it?
That is the most accurate assessment. And one last point on eligibility that we have to mention. The Roth 401k has a really big advantage over the Roth IRA for some people.
You're talking about high earners.
Yes. The Roth IRA has a strict upper income limit. If you earn too much, you just can't contribute, period.
Right.
The Roth 401k, on the other hand, has no income restriction at all. This makes it an incredibly valuable tool for what the IRS calls highly compensated employees, or HCEs, who are locked out of the Roth IRA. It gives them a way to get that permanently tax-free growth that's otherwise unavailable to them.
Okay, so shifting from that philosophical choice to the hard reality of compliance, the annual contribution limits.
And these are absolutely unforgiving. If you get this wrong, the penalties can be devastating.
So we need to break down two separate limits. The first one is the one most people know about, and it limits what you, the employee, can put in from your salary.
That's the employee elective deferral limit. Or, if you want the code, the 402G limit.
For the latest year we have in our sources, that limit was $23,000 for 2024.
And that's a combined total, right, for both your traditional pre-tax and any Roth post-tax contributions you make. It all goes in one bucket against that limit.
And these limits aren't static.
No, they're indexed for inflation. They usually go up in $500 increments. And Congress also created a special provision for older workers, the catch-up contribution.
This is for employees who are age 50 or older at any point during the year. For 2024, that catch-up limit was an extra $7,500.
So an older employee could contribute up to $30,500 in total. And our source have pointed out a very specific temporary increase to that catch-up limit coming in 2025 and 2026, specifically for people aged 60 through 63.
So that's a targeted effort to let people who are really close to retirement save even more right at the end?
Exactly. It's a government push to facilitate that late-stage saving.
Okay, so that's just the employees part. The second limit is much, much higher. It's the total amount that can go into the account from all sources, employee and employer.
That's the Section 415 limit. This is the absolute ceiling. It includes your deferrals, your catch-up, any employer match, and any profit sharing.
And the limit is?
It's the lesser of 100% of your compensation or a statutory dollar amount. For 2024, that was $69,000, plus your catch-up if you're eligible.
We should probably clarify how the employer match works with the Roth choice, because that can be confusing.
It can. Employer matching funds are great, but they always have to be made on a pre-tax traditional basis.
Always.
Always. So if you contribute $10,000 to your Roth 401k and your employer puts in a $5,000 match, that $5,000 from them is traditional money, you'll pay tax on it when you withdraw it down the road.
And some companies also do profit-sharing contributions.
Yes. And those are separate from your own contributions. But just like the match, those profit-sharing dollars are pre-tax, and they count toward that big aggregate Section 415 limit.
Before we get into penalties, there's a specific group of workers who are sort of left out here, government employees.
Right. Federal, state, and local governments are generally barred from offering 401k plans if the plan was established after May of 1986. They usually offer something called a Section 457B plan.
Which is similar but not identical.
Similar limits but different rules, especially around when you can get your money after you leave your job.
Okay, let's talk about the danger zone. Over-contribution. This happens a lot when someone switches jobs mid-year, right?
Oh, it's a huge risk. The new company's payroll system has no idea what you contributed at your old job. But the limits apply to you, personally, across all the plans you participate in for the year.
And if you go over that 402G limit,
you have to fix it. The excess contribution plus any earnings it generated has to be distributed back to you by April 15th of the following year.
And if you miss that deadline, you fall into the double taxation trap. How does the IRS manage to tax you twice on the same money?
It's brutal. The initial excess contribution was never a valid deferral, so it's taxable income in the year you earned it. That's tax number one.
Okay.
But if you make the correction late, The distribution of that excess money is also reported as income in the year you take it out. That's tax number 2. You get taxed twice on the principal amount you contributed by mistake.
That is just a punishing outcome for what could be a simple mistake. Okay, finally, let's quickly hit the contribution deadlines. They're different depending on the business.
They are. For a standard corporation or an LLC, taxed as one, contributions generally have to be in by the end of the calendar year. But for unincorporated businesses, sole proprietorships, partnerships, the deadline is much better.
How so?
It's extended all the way to your personal tax filing deadline, so April 15th or even September 15th if you file an extension.
The 401k is designed for long-term saving, and the IRS uses some pretty heavy financial incentives to make sure it stays that way.
Absolutely.
So we need to get into the rules around early access, starting with the big one, the general penalty age.
The magic number is 59.5. If you take any money out before then, you get hit twice. First, you pay ordinary income tax on the amount, and second, you pay a separate, very painful 10% penalty excise tax.
So it's designed to make you think twice, or 3 times.
It is. It's there to ensure the money stays invested for its intended purpose, which is retirement.
Okay, but there are emergency exits. The one people ask about most is the hardship withdrawal. The IRS has a very narrow definition of a real hardship.
Very narrow. The code lays out 6 specific reasons. Things like unreimbursed medical expenses, costs for buying your primary home, some educational costs for the next 12 months.
Things to prevent foreclosure or eviction.
Right, funeral expenses or repairs for damage to your main home. It's a specific list.
But then this is the crucial part for you, the listener. Even if the IRS says it's okay, your employer can still say no.
That's the critical footnote. The employer is the final gatekeeper. The specific plan document determines what's allowed. An employer can, and often does, choose to disallow some or even all of those hardship reasons.
And we should probably mention, the CARES Act in 2020 was a temporary exception to all this.
It was. It allowed penalty-free withdrawals of up to $100,000 for people dealing with pandemic-related issues. But that was a very specific temporary measure.
So beyond hardship, what are the other common ways to get your money early without that 10% penalty?
Well, the sources list a few key exceptions. If you leave your job in or after the year you turn 55, that's called the age 55 rule, you avoid the penalty. You also avoid it in cases of death or total and permanent disability. Distributions that are part of a divorce settlement, a QDRO, also avoid it. And then there's a complex one called substantially equal periodic payments, or 72T payments.
Let's talk about 401k loans. A lot of people see this as borrowing from yourself, no big deal. But there's a hidden tax flaw.
There is. On the surface, it seems great. The interest you pay on the loan goes right back into your own 401k account, so you're kind of paying yourself interest.
Right.
The problem, the tax complexity, comes from the fact that you make those loan repayments, including the interest, using after-tax money.
So you pay tax on your salary, and then you use what's left to pay the interest on the loan.
Exactly. But that interest you pay back doesn't increase your after-tax basis in the 401k. So when you eventually withdraw all the funds in retirement, that interest money, which you already paid tax on once, gets taxed again as ordinary income.
Double taxation on the interest.
It is. It makes the real financial benefit of the loan very questionable.
And the risk if you default is huge.
Immense. The code says you have to pay the loan back in 5 years max, unless it's for buying your main home. If you default on that, or if you leave your job and can't pay it back,
What happens?
the entire outstanding loan balance is immediately treated as a taxable distribution. So you're paying ordinary income tax on the whole amount, plus the 10% early withdrawal penalty if you're under 59.5. It's a tax torpedo. It can be financially devastating.
So the government lets you defer taxes for decades, but eventually they want to get paid.
They want their share.
And that brings us to the mandatory drawdown rules. Required minimum distributions, or RMDs.
RMDs are just the government's way of forcing you to finally recognize that deferred income so they can tax it. Generally, you have to start taking distributions by April 1st of the year after the year you turn 72.
Is there any way to delay that if you're still working?
Yes, there's a vital working exception. The RMD isn't required if you are still employed by the company sponsoring the 401k plan for the whole year and you own less than 5% of that business.
But once you retire, the clock starts ticking.
The clock starts. The RMDs have to begin.
And the penalty for not taking an RMD seems, it's draconian, 50%. Why is the IRS so aggressive on this?
Because if they don't force you to take the money out, the whole tax deferral system breaks down. They let you defer tax for decades, so they have to ensure they eventually collect it. The penalty is 50% of the amount you should have taken out. It's designed to make you comply.
And just to be clear, RMDs apply to both traditional and Roth money inside a 401k, right?
They do, which is a key difference from a Roth IRA, which has no RMDs for the original owner. In a 401k, you have to take them from both sides.
The moment an employer decides to offer a 401k, they walk into this very complex world of compliance, specifically non-discrimination testing, or NDT.
And the whole point of NDT is to stop the plan from just becoming a tax shelter for the company's top earners.
It's about fairness.
It's about ensuring the lower-paid employees actually benefit, which in turn puts strict limits on how much the highly compensated employees, the HCEs, can contribute.
So let's define an HCE clearly. What is it?
It's based on two things. Either your compensation is over a certain amount, for 2025, that's $160,000, or you own more than 5% of the business. Either one makes you an HCE.
And the main test they have to pass is the actual deferral percentage test, the ADP test. Explain the 2% rule.
The ADP test compares the average contribution rate of the HCEs to the average rate of the non-highly compensated employees, the NHCEs. And the rule is simple but powerful. The HCE average cannot be more than 2 percentage points higher than the NHCE average.
Let's use a real example. Say the regular employees, the NHCEs, only contribute an average of 1.5% of their salary, but the executive they're putting in 10%. The plan fails badly.
Fails badly, correct. If the NHCE average is 1.5%, the HCE average can't be higher than 3.5%. So if the plan fails, the employer has a big problem to fix.
And what are their options?
The most common solution is they do a return of excess. They literally have to send taxable refund checks back to the HCEs to get their average contribution rate down.
Or they can do a QNEC.
A qualified non-elective contribution. This is the more expensive option for the company. They make an immediate 100% vested contribution to all the NHCEs to artificially raise their average deferral rate up to a passing level.
So they give the lower-paid employees more money to make the test work.
Exactly. If they boost that NHCE average from 1.5% up to, say, 4%, then the HCEs would be allowed to defer up to 6%.
And that cost is what pushes a lot of companies toward a safe harbor plan.
It is. A safe harbor plan is designed specifically to get out of that ADP testing altogether. The company agrees to make a guaranteed 100% vested contribution to all eligible employees, either as a match or as a flat contribution.
And in exchange for that guaranteed cost, they don't have to worry about the testing anymore.
The compliance headache just goes away.
Okay, shifting gears to fees. This is often called the silent killer of retirement growth. What should you, as a listener, be looking for?
You have to look past the performance numbers and dig into the expense ratios and administrative costs. Fees cover everything: record keeping, administration, investment management.
And they add up.
They do. Back in 2011, the average total fee was around 0.78% of assets. That's about $250 a year per participant. But for small businesses, those fees can be way higher, sometimes double the average.
And the whole issue of excessive fees led to that landmark 2015 Supreme Court case, Tibble v. Edison International.
That case was so important. The court ruled that plan administrators could be sued for excessive fees, and it established they have a strict, ongoing fiduciary duty to monitor those fees.
What was the specific issue in that case?
The court called out the use of more expensive retail class mutual funds when cheaper, identical institutional class shares were available. Plan sponsors now have to prove they are constantly monitoring fees to make sure they are reasonable.
Okay, so to fight low participation, especially among the NHCEs, we've seen this big push for automatic enrollment.
Right, where you're in the plan unless you actively opt out.
And to protect the employer in that scenario, they created the QDIA.
The Qualified Default Investment Alternative. This came out of the Pension Protection Act of 2006. If an employee gets auto-enrolled but never chooses their investments, the money has to go into a QDIA.
And what are typical QDIAs?
They're usually professionally managed funds that are designed to be risk appropriate. So things like target date funds, balance funds, or managed accounts.
And by using one, the employer is protected.
They get fiduciary relief. If the investments lose money, they're protected because they follow the legal mandate for a suitable default option.
So when you leave a job, you face the rollover decision. There's a right way and a very risky way to do it.
The right way is the direct rollover. The money moves straight from the old plan to a new plan or an IRA. No taxes, no penalties. It's clean.
The risky way is taking the check yourself.
Right. If you take possession of the funds, you have to complete the rollover into a new account within 60 days.
And if you miss that 60-day window,
The entire distribution becomes taxable as ordinary income, and if you're under 59 and a half, that 10% penalty applies.
and there's another catch, right? Withholding.
Yeah, the employer is legally required to withhold 20% of the distribution for taxes, which means if you want to roll over the full amount, you have to come up with that 20% out of your own pocket to complete the rollover and then wait to get it back from the IRS when you file your taxes. It's a mess.
What about converting traditional funds to Roth inside your company's plan? Can you do that?
The IRS does allow what's called an in-plan Roth conversion, but there's a huge caveat.
What's that?
The company plan has to offer both a traditional and a Roth option, and the plan documents have to explicitly say that these conversions are allowed. If they do, you can do it. You pay the income tax on the converted amount that year, and then it grows tax-free forever.
Okay, finally, let's touch on plans for small businesses and the self-employed, because the rules there really loosened up about 2 decades ago.
Yeah, EGTRA in 2001 was the key legislation. It raised the maximum employer profit-sharing contribution from 15% all the way up to 25% of eligible pay.
Which was a huge deal for business owners.
A massive deal. It drastically increased their savings capacity. So an incorporated person can put in their maximum employee deferral plus that huge 25% profit-sharing contribution, all the way up to the total Section 415 limit.
But there's a critical difference for unincorporated people, like a sole proprietor. The math gets a little tricky.
It does. For someone running a Schedule C business, the profit sharing is calculated as 25% of their net self-employment income, and because the contribution itself is deductible, it reduces the net income you use for the calculation. So the actual rate ends up being a little less than 25%.
So for a sole proprietor with $100,000 in gross income, the actual contribution would be more like $20,000, not $25,000, because that $20,000 contribution lowers their income before the calculation is even applied.
Exactly. You need precise accounting for that. It's a circular calculation.
And one last complex maneuver we should define, ROBS rollovers as business startups.
Right.
Using retirement money to fund a new business, is that actually legal?
It is if you follow the very specific IRS rules. It lets you use your existing 401k funds to buy stock in a new C corporation that you're starting.
And you don't pay taxes or penalties.
Correct. It's a way to get startup capital through a tax-free transaction. The IRS watches these plans very closely, but they are a valid, if very complex, financing option. Can Tag 6, global context, critiques, and the future.
So while the 401k is uniquely American in its name and origin, the idea of a defined contribution system is global.
Oh yeah, the term 401k has almost become generic worldwide. Japan, for example, adopted what they call a Japan version 401k back in 2001. Other countries have had their own schemes for a long time.
Like in the UK or Canada?
Right, the UK has personal pension schemes. Canada has RSPS, Registered Retirement Savings Plans, which are a little different because they're individual vehicles, not strictly tied to an employer.
How is Australia's system fundamentally different from the U.S. model?
Australia's superannuation funds are really interesting because of the mandatory employer contribution. Yeah, Australian employers are legally required to contribute a certain percentage of an employee's salary into their fund. This ensures a baseline level of savings that isn't dependent on whether the employee chooses to participate or not. That mandatory piece is what's missing in the U.S.
And what about in Asia? What models do we see there?
Well, India's national pension system, the NPS, works a lot like the 401k for government and corporate workers. Similar rules for investing and taxes. And in Malaysia, you have the Employees Provident Fund, or EPF. It was established way back in 1951. It's mandatory for private sector workers, and it ensures huge savings and broad participation.
Okay, now we have to turn to the system's deep structural flaws. Flaws so severe that the inventor himself, Ted Benna, once said he felt like he had created a monster.
And the first, most basic criticism is just the risk of loss. It's inherent in any defined contribution plan.
Right. There is no government guarantee.
Absolutely none. Unlike a pension or an FDIC-insured bank account, the assets in your 401k can go to zero.
And even if you diversify and shift your risk as you get older, you're still exposed to huge market declines like what we saw in the Great Recession.
And that risk is compounded by the hidden costs, the fees. A plan sponsor going bankrupt won't lose your assets, but those excessive fees from providers act like a constant, silent drag on your returns year after year.
The second major critique is the incredible burden of choice that's placed on the employee. Why is our entire national retirement system built on the assumption that non-experts can choose and manage complex investments?
It's a huge and I think unfair assumption. The complexity of picking funds, rebalancing, updating your choices for 40 years,
Huh?
it's a major failure. It's why a lot of people, especially lower income workers, just don't sign up at all.
Target date funds were supposed to fix that.
They were attempt to mitigate it, sure, but even those require a certain level of trust and a basic understanding of risk.
The third critique, and maybe the most politically charged one, is inequality. The tax breaks just overwhelmingly benefit people who can afford to save the most.
Precisely. If you're a high earner, that tax deduction is worth a ton of money. If you're a low-income earner, the deduction is negligible or even zero.
And the stats are pretty stark.
They are. Our sources cited data showing the highest earning groups save enough to get about 11 times more in retirement income than the lowest earning groups. It directly widens the wealth gap.
And beyond that, there's just the participation gap. Not every employer even has to offer a plan.
It's totally voluntary. Millions of workers have no access to the system's tax advantages at all. And this is something Ted Benna himself has proposed fixing. He suggested mandating that companies over a certain size have to offer a 401k to ensure wider access.
And all of this leads directly to the core problem. Are people saving enough?
And the answer seems to be no. This reliance on defined contribution plans means retirement income is just wildly unpredictable.
What was that statistic?
It was a deeply concerning one. In 2017, 49% of Americans between the ages of 55 and 66 had no personal retirement savings. None. Zero. That huge gap means a massive part of our population is facing either working into old age or living in poverty, relying only on Social Security.
So given all of these really severe criticisms, there are now some pretty big proposals on the table to fundamentally change how we do retirement in the U.S.
Yeah, one bipartisan idea is to open up the federal government's thrift savings plan, the TSP, to all employees, not just federal workers.
And that would provide a more stable, defined income structure.
And it would leverage the massive scale and the super low costs of the TSP.
And then there's the most provocative proposal, which is to just end the 401k tax break entirely. What's the economic thinking there?
The researchers behind that argue that the tax break doesn't actually create new savings on a national level. It just encourages high earners to shift money they were already going to save from a taxable account into a 401k to get the break. So they say the subsidy is ineffective.
And if they got rid of the break, what would they do with all that new tax revenue?
They estimate it would bring in about $200 billion a year in additional revenue. And they propose using those massive funds to directly support and shore up Social Security.
So shifting the focus back to a universal, guaranteed safety net.
Exactly. It completely challenges the philosophical foundation of American retirement. It asks, if the current system is failing almost half of all near retirees, should we keep prioritizing tax breaks for individuals? Or should we shift our resources back to a guaranteed benefit program for everyone? #Chag outro.
We have covered a vast amount of ground today. From the accidental birth of the 401k as a tax dodge for executives facing a 70% rate.
All the way to its current, very complex structure that's struggling with these huge questions of equity and sufficiency.
So the key takeaways for you, the listener, are really critical. First, master that tax duality.
Right. Traditional, or EET, means you pay tax later. Roth, or TEE, means you pay tax now. But remember, in both cases, the real prize is the permanently tax-free profits.
Second, be hyper-vigilant about compliance. Know your personal contribution cap, that 402G limit, and understand that brutal double taxation penalty if you go over, especially when you switch jobs.
And you have to understand the immense burden that's placed on you. The burden of choosing investments, of monitoring fees. It's all on your shoulders.
And finally, just remember where the system's flaws come from. The 401k was designed as a niche tax dodge for the highly compensated, and it just sort of accidentally became the default retirement vehicle for the entire country.
So that leaves us with a final provocative thought.
Given its inherent market risks, the complex burden of choice it puts on the average person, and its very real contribution to inequality, should the U.S. government continue to prioritize these massive tax breaks for individual savings, or should the focus shift back toward universal, government-funded, defined benefit security? What are you willing to trade for that tax deferral? Thank you for joining us for the deep dive.